Most people around 55 are doing one of two things with retirement accounts. Either they're maxing out every catch-up dollar the IRS allows, or they're contributing roughly what they were contributing at 42, maybe a little more, and assuming that's fine. Those two groups don't end up in the same place. Vanguard's 2024 How America Saves report found that workers who actively use catch-up provisions accumulate, on average, roughly 30% more in their accounts by the time they hit their early 60s compared to similarly aged workers who don't, 30% on the same salary. The difference isn't income, it's knowing the rules. And the rules around age 55 specifically are more generous than most people realize. The question is whether you know what you're actually entitled to put away right now. Let me walk you through the whole structure, how it layers, what each piece does, and what the math actually looks like when you put it together. The base layer is the standard 401k deferral limit, which for 2026 sits at $24,500. That's the most any employee under 50 can put into a traditional or Roth 401k from their paycheck. If you're 50 or older, and if you're watching this, you probably are, the IRS adds a catch-up on top of that. The age 50-plus catch-up for 2026 is $8,000, which brings your total possible employee deferral to $32,500. Most people in their 50s have at least heard of the catch-up. What they haven't heard of, and this is the one that actually surprised me when I first dug into the Secure 2.0 Act language, is what happens between ages 60 and 63. Congress, in Secure 2.0, signed into law at the end of 2022, created what the IRS now calls the Super Catch-up. Starting at age 60 and running through the year you turn 63, your catch-up limit jumps to $11,250 instead of the standard $8,000. So if you're 61 this year, your total employee deferral ceiling isn't $32,500. It's $35,750. That's $24,500 in base deferrals plus the $11,250 super catch-up. And at 64, you drop back down to the regular $8,000 catch-up. So this is genuinely a 4-year window, not a permanent upgrade. I'd write those years on a sticky note somewhere visible if I were in that range. The window closes, and the IRS isn't going to send you a reminder. Now, I spend my days digging into the rules retirees actually have to live with, and honestly, the age 60 to 63 super catch-up is still underused because most HR departments haven't updated their employee communications to reflect it. I've heard from people whose plan administrators still only quote the $8,000 number. So if you're between 60 and 63, it's worth calling your plan's benefits line directly, asking specifically about the Secure 2.0 Super Catch-up and confirming your plan has adopted it. Most plans did, but not all plan sponsors moved immediately. Adoption wasn't automatic. Your individual plan document is the controlling document, not a general IRS announcement. One thing worth clarifying here, because I see people get this wrong. These limits are per person, not per account. If you have a 401k from a current employer and a 403b from a side job, the combined employee deferral across both plans is still capped at $32,500 or $35,750 in the super catch-up years. The IRS limit doesn't multiply because you have multiple accounts. Employer contributions are a separate calculation and don't count against your deferral limit, but your own contributions across all plans have to stay under one ceiling. That matters if you're doing any part-time or consulting work with a second plan on the side. Now let's talk about IRAs, because a lot of people treat this like it's one or the other, either a 401k or an IRA, and that's backwards. They're stackable. For 2026, the IRA contribution limit is $7,500. If you're 50 or older, you get an additional $1,100 catch-up on top of that, bringing your IRA ceiling to $8,600. That's either a traditional IRA or a Roth IRA, or split between both. But $8,600 total across all IRAs combined. The Roth IRA does phase out based on income, so your filing status and MAGI determine whether you can contribute directly. For 2026, the Roth IRA phase-out for single filers starts at $150,000 and closes out at $165,000. And for married filing jointly, it runs $236,000 to $246,000. If you're above those thresholds, the backdoor Roth conversion is a conversation worth having with a fiduciary. but that's a whole separate video. The third layer, and the one I genuinely think gets the least attention, is the HSA. Health savings accounts aren't just for medical bills. They're the only account in the tax code that gives you a deduction going in, tax-free growth in the middle, and tax-free withdrawals coming out, as long as the withdrawal is for qualified medical expenses. After age 65, you can withdraw for any reason and just pay ordinary income tax, making it functionally similar to a traditional IRA. For 2026, the HSA contribution limit for self-only coverage is $4,400. Add the age 55 plus catch-up, which is $1,000 flat and doesn't change with inflation, and you're at $5,400 for the year if you're 55 or older. The family coverage limit is $8,750, plus the same $1,000 catch-up for a total of $9,750. You do have to be enrolled in a qualifying high-deductible health plan to contribute, and you can't contribute to an HSA once you're on Medicare. So this window is roughly age 55 to 64 for most people, which is exactly the window we're talking about. Let me walk through a worked example, because abstract limits only go so far. Say you're 61, you earn $95,000. Your employer matches up to 4% of salary, which is $3,800. And right now, you're contributing 10% of pay, or $9,500 a year. You're participating. You feel like you're doing the responsible thing. But look at what you're leaving on the table. Your IRS ceiling for employee contributions at 61 is $35,750, the base $24,500 plus the $11,250 super catch-up. You're contributing $9,500. That's a gap of $26,250 in unused deferral space just on the 401k. Now add the IRA, $8,600. Add the HSA if you qualify, $5,400. Your total possible tax advantage contribution space this year is $49,750, and you're using less than $10,000 of it. I'm not saying you have to fill all of it. Most people at 61 earning $95,000 can't mathematically redirect $49,750 from take-home pay and still pay their mortgage. But even moving from 10% to 20% and adding roughly another $9,500 closes the gap meaningfully, and the employer match of $3,800 is already in the calculation, as long as you're hitting whatever threshold triggers it. The point isn't to feel bad about the gap, it's to see it clearly enough to act on it. Here's what I'd do if I were in that chair. Prioritize the 401k first, at minimum through whatever percentage captures the full employer match, because that match is an immediate 100% return before any market movement. And then fund the IRA and then the HSA if you're eligible, in that order. Other financial commentators sometimes flip the IRA and HSA depending on investment options, and I understand the argument. The 401k match floors the decision for most people. Leave $1 of match uncaptured and you're voluntarily giving back part of your compensation. Now, there's a timing wrinkle that trips people up, and I want to make sure you're not one of them. The IRA contribution for a given tax year can actually be made as late as the tax filing deadline, so April 15th of the following year for most people. That means if you're sitting here in mid-2026 and haven't yet maxed your 2026 IRA, you still have until April 2027 to do it. The 401k deferral deadline, though, is December 31st. Payroll deferrals don't get the spring extension. If you want to increase your 401k contributions for 2026, you need to update your deferral election before the last payroll of the year runs, waiting until January to catch up on last year's 401k. That's not how it works. January contributions go toward the New Year's limit. I've seen people lose a full year of catch-up space over that one misunderstanding. One more thing the legislative history explains and most people don't know. The original catch-up contribution, the age 50 version, was created by Ichara in 2001. It was intended to be temporary, a sunset provision. Then, Congress made it permanent. Secure 2.0 in 2022 built the super catch-up on that foundation, and it also indexed the regular catch-up to inflation going forward. So that $8,000 figure is likely to inch upward over time in $500 increments, the way the base limit does. The IRS adjusts in $500 steps, so don't assume it stays at $8,000 forever, but for 2026, $8,000 is the confirmed number. The super catch-up is $11,250 for 2026. Plan around the confirmed figures. Check the IRS. Notice every fall for the following year's adjustment. The math here is almost never as hopeless as it feels at 55. Not always comfortable, not always easy to execute, but the window is genuinely open. The rules are on your side in a way they weren't for people in their 30s, and the contribution limits are higher right now than they've ever been. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this gave you a clearer picture of what you're actually allowed to do, subscribe. There's a lot more in this playlist built specifically for the 55 to 70 stretch. And next up, if your income crosses $103,000 in retirement, Medicare hits you with a surcharge most people never see coming. That's IRMAA, and I'm breaking down exactly how it works and what the 2026 numbers look like. Don't miss that one. If there's a specific rule or retirement question you'd like me to dig into, Roth conversions, RMD timing, Social Security filing strategy, drop it in the comments and I'll work it into an upcoming video. I read every one,